Good afternoon and welcome everyone to today's US markets update and third quarter earnings review. Great to see so many on today's webcast. My name is Kelly Meng, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster, along with Portfolio Managers Stephen Lyle, Chris Wallerman, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the question and answers tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I'll now turn the presentation over to Joe.
Good evening. I guess in the United States, as the election is in full swing and it's uncertain where the outcome will be, there's an economic concept that we would learn in America in what we call Econ 1A, called guns versus butter. And the concept of guns versus butter is the idea of a limited productivity frontier that an economy has, and the choice that a government has to make between choosing to make, for example, guns or butter. The productivity efficiency frontier is now, let me see if I can get this up on the screen. It basically shows the government's ability with a finite number of resources to produce one or another food or defense. So let me see if I got control here. So it's a trade-off between finite resources that a government must make. And in the United States, of course, the US government has chosen the economy over containing the virus to the extreme of the models around the world. And the contrary, just coincidentally, the contrary extreme has been Victoria, the state of Victoria, where it's chosen containment over the economy to the extreme. And as a result of choosing one or the other, the frontier will contract. So the U.S. economic activity will fall, and the Victorian economic activity will fall more. In Europe, there's more of a combination between guns and butter and the choice of the economy over containment. As these frontiers contract, what we end up with is a new frontier from which we can grow in the future. And the vaccine, if one's coming shortly, will determine which of these strategies is going to work the best. For example, if a vaccine did come out tomorrow, then the US strategy, economic strategy, and I'm not talking about the deaths here, I'm talking about economic strategy and how it affects the stock market. A vaccine tomorrow, the US would win. If there's no vaccine, then Victoria would win by having a stronger frontier of productivity, but it would remain isolated from the rest of the world. And so the velocity of creative destruction, which is a concept that you should all be familiar with now, is going to affect these differences. For example, in Australia and Victoria in particular, we lose students because if we remain isolated with no vaccine, we're not going to be allowed to have these students coming into the universities. Whereas in the United States, the velocity of creative destruction is reflected in the FANGs, the Facebook, Amazon, Netflix, Apple, and Google, and the rapidly shifting economy that there is in the United States. So I wanted to get this concept across of guns versus butter and help you understand that the US would benefit, has a much stronger economy than anywhere else in the world. But they do have more deaths. So the S&P 500 did fall in the last month while earnings estimates were up. That's bringing the price earnings ratio for the S&P 500 down. Kelly, you have the questions and answers there? It's kind of strange speaking to a computer Normally I have an audience where people are putting up their hands and nodding. Kelly, are you monitoring the questions and answers?
No, I don't have control of the screen at the moment.
Okay. Okay. The 10-year Treasury is up. If the yield on the 10-year Treasury is going up, what that's indicating is a stronger economy. But there's, at these sorts of levels, absolutely no risk of inflation. Of course, a few years ago, the stock market became very skittish on the concerns of deflation. And deflation doesn't seem to be entering into the psyche of the market at all right now, despite the slowing growth. But the 10 basis point increase in the 10-year Treasury is indicating that the economy is recovering from the second quarter, which was the worst of the COVID contraction. Late in this month, we did see some rotation out of the COVID winners, the FANG stocks or the clicks and snacks type stocks, into reopening stocks. So these are going to be some of, not necessarily the heavy balance sheet companies like hotels and cruise lines and oil, but some stocks that would be more cyclically exposed, restaurants, et cetera. And low interest rates is certainly benefiting the housing and auto sector dramatically. So we've seen big run up in auto and housing stocks, particularly in the last month or 2 months, as low interest rates encourage purchases of homes and autos. There's been profit taking in the non-cyclicals more recently. So where food and consumer products had been very strong, there seems to be some profit taking and rotation out, with the exception of Clorox, which had very, very good results after this report was written. And Clorox is now going to, I think, blow a bunch of money on advertising, is what they've said. But easy come, easy go. I think that's an overbought situation in many of these consumer product stocks. There's an exception in food with Kraft Heinz, which we'll talk about as well. Now, the big balance sheet cyclicals, aviation, the airlines, as well as Airbus and Boeing, they're still struggling. Oil can have these bounces, but they're really not doing well in general. And cruise lines can be very volatile because there's such a high risk horizon on when they come back into business, but we would not be going anywhere near the big balance sheet cyclicals at this stage. Too early for them. Banks have had great earnings. You may recall last quarter, we had some $30 billion in credit write-offs or bad debts that the banks had to allow for. And that has all but disappeared this quarter. So we've had almost no write-offs or asset impairment charges. And even though we've had very, very good earnings, these companies have not performed with the market because they tend to, the market appears to be waiting for the economic cycle to improve and interest rates to improve more than 10 basis points. I think if the interest rates went up by 50 basis points, you'd see those stocks surge. The biggest movers in the market, there are some anomalies in here I want to point out. Harley Davidson, we're getting buyers because of low interest rates, but Cleveland Cliffs and U.S. Steel, there was a big run up in steel this month. And we're not investing in those stocks because they're such a small part of the economy. But I did want to point out here that Mattel, which had been struggling for years under declining sales of Hot Wheels and Barbies, has had a bounce back as new management has shifted into providing more of an electronic or games type product for its customers. So it was surprising to see that this shift in strategy is working. The new CEO is getting some traction in his strategy, and Mattel's had a good month. General Electric, also Larry Culp, I'll talk a little bit more about him. The stock is not beyond where we sold it. It's not doing well, but it did have a good month after reporting earnings, and that 21% increase this month is after quite a very sideways movement for the last 6 months. Gap, very good results from the Gap. But next down, Ford and General Motors doing very well. Housing stocks are doing well. Then we have Xilinx with a takeover offer. Martin Marietta is a materials company that does things like tar for roads and building materials. So they could benefit from a Biden win and the $7 trillion expenditure that he's indicated that he wants to put together a new deal like Roosevelt had, where he would have giant infrastructure works. So that would also benefit Southern Copper. On the downside of the market here, Bayer has made this horrible, disastrous acquisition of Monsanto and acquired a lot of genetically modified seed businesses, which are potentially going to result in very large lawsuits, class action lawsuits. They're not doing well. Vertex is a biotech company, and I want to get into them in a little more detail later, but they had a drug that did not get through FDA approval processes, and as a result of this, what was a promising drug falling off of their platform, the stock has fallen 23%. Bombardier, if you may recall, they were making planes and selling them to Delta, and United didn't like that. And Donald Trump was trying to hold Canadian manufacturers accountable. There was a big lawsuit where Boeing sued Bombardier, saying that the Canadian government had subsidized them, and they, even though Boeing lost that lawsuit, Bombardier, which fell into the hands of Airbus, is now going bankrupt. So they had a Pyrrhic victory in winning that cross-border trade issue, but Bombardier has now been legislated out of business, probably, which is a sad thing to see, but that's the way the world works. On the downside, also, we have Royal Caribbean and the other Carnival Cruise, et cetera, down significantly. And on MasterCard, I want to point out, they were down with Visa. There's also some downward rotation in the US big pharma stocks, where we've seen in particular concerns about legislation from a new Biden administration, which looks probable. Chris, Steve, any comments on some of those stocks before because I get some buy-in from you guys? Comments?
Yeah, I think that, looking to Royal Caribbean and some of these other COVID exposed companies in sectors that have underperformed may continue to, if we see this surge in new cases continue, particularly in the US.
Yeah, very sensitive to that reopening thematic and the pace that they're expected to return to service. The travel ban expired, I think, on the 1st of November, but like the airlines, the cruise businesses are relatively low margin and rely on pretty full capacity or high capacity utilization levels to be profitable.
Yeah, I think that's an important point, Chris. I mean, the high capacity utilization is a dependency, and they might be better off having no cruises than 50% of the cruises. It's like an airline flying is better off not flying than flying half full.
That's right. Yes, there's a significant degree of operational leverage, and there's additional costs to comply with the new safety standards. I think some of the cruise lines are anticipating some mock cruises, so cruises without any passengers, and then the marketing expense and the in some cases 125% travel credit that they're providing for booked cruises that have been cancelled. They all eat into the bottom line.
Yeah. And Tim, there's a question from Tim there. Yes, the Harley Davidson is benefiting from low interest rates, as it's housing and Ford and General Motors and other auto companies. So the answer is yes, Harley Davidson is benefiting from lower interest rates. Thank you for asking. On the macro front, and this is the earnings review, but I do want to touch on some macro issues because of the election and what's driving things. But the three influences on the market at the moment are whether there'll be a new fiscal stimulus package passed by Pelosi and Trump. Second, of course, is the 90,000 a day infections, but the much lower death rates in the United States. And then the third macro issue affecting the market will be the results of the election, which it looks like Trump might be winning Florida, but he's less likely to win, and Biden's more likely to be the next president. There will be stimulus before January. The U.S. will not be able to survive the lame duck section if it is one, where Trump is on his way out but doesn't leave until January. And as a result, there will be some stimulus passed after the election. If the Democrats win, there'll be much more stimulus in January or thereafter. With 90,000 cases a day, hospitals are going to be very busy, and elective surgeries will be down, which will impact the medical device companies, but the hospitals will be busy caring for people who have viruses. If a vaccine takes longer, as I described before, to get to market, the state of Victoria will remain isolated, and the U.S. would end up having a stronger economic base. I think that something that the world incorrectly fantasizes about is that you can shut things down for 6 months and then automatically pop back to where you were. And it just doesn't work that way. If it falls by 10%, people are going to go out of business, and then they'll have to restart with new capital and new businesses. So I think that there's some wishful dreaming out there that that we can just bounce back right to where we were, and that is not what will happen in my opinion. France and Germany, of course, they're somewhere in between. They've got new lockdowns there to try and save lives. I'm not sure what's going on in Italy, but France and Germany have new lockdowns. The UK has regional lockdowns, and their guns versus butter approach is to have more balance than the extreme views taken by the US and Victoria. And of course, the winter is coming. So there's 3 vaccines in phase 3 trials. Some of them look promising, but in my mind, we're minimum 12 months out before people are not afraid of getting sick, and it's probably more like 24 months. So in my view, the economic policy, and I emphasize the word economic policy, of allowing the virus to spread and keeping the economy open will be the more successful economic strategy. And it's not my job to analyze the economy, what stocks are going to move. So don't be offended by that I have a lack of concern for life. That's not the point that I'm trying to make. The U.S. government, the question becomes in the U.S. now, does the U.S. want a government run by maverick or consensus? Of course, Donald Trump being a maverick and Joe Biden being by far the oldest potentially elected president, I think he's 78 now, would not last the full 8 years. And so it would be a government driven more by consensus. Biden does plan on having a very large stimulus package. He will have higher taxes immediately, nationalized healthcare, and what they call the New Deal to create jobs. Now, Steve, do you want to describe what the New Deal was under Roosevelt during the Depression so people have that background? I mean, you and I being from the United States probably know more about that than our Australian clients might.
Yeah, it was a series of projects, mainly public works projects, that the U.S. government spent enormous amounts of money on to stimulate GDP as well as increase employment So there were a number of regional projects at that time. For instance, the Hoover Dam was part of it. Some major infrastructure changes in the country during that period, but it was mainly a stimulus through huge government spending. Also part of it was the Social Security program, which was meant to be a safety net for retired and older people.
But as Nancy Pelosi is talking about the Democratic strategy at the moment, the New Deal would be infrastructure projects. So it'd be borrowing money, raising taxes, and spending money on infrastructure such as airports and trains and things like that.
That's right, as well as a part of that will also be spent on renewable energy technologies. So
yes, and a shift to clean energy.
That's right.
So the $7 trillion package, if you have an economy that is generating, say, $20 trillion a year in GDP, and you have as much debt, and you have the debt from the Treasury, and you have the quantitative easing, which is causing the U.S. central bank to have a lot of assets that it'll have to burn off its balance sheet over a long period of time. There's a tremendous amount of debt out there already that can be serviced because the interest rates are very low. And if we add $7 trillion on the Democratic ticket, it becomes a pretty scary scenario. If the economy does improve and interest rates go up, then the U.S. could not afford to service those debts. So it is a crazy new world where these low interest rates make borrowing money effectively free.
You know, it might be worth noting that the New Deal had mixed results in the 1930s, and it's arguably true that it took World War II to get the U.S. out of its economic slump.
Yes, yeah, which left the U.S. in debt again. But left it with as the global police force, like it or not. Now, this New Deal with $7 trillion in expenses or expenditures is supposed to create jobs for the 11 million unemployed. Now, another thing that Biden is talking about is cutting the cost of healthcare, and that effectively being a reduced expenditure or a dividend or an allowance for middle America to be able to spend money on other things. So it gives Americans money by hurting the major pharmaceutical companies and the pipelines and reducing healthcare costs. I have trouble seeing how they're going to make that work, but because they haven't been able to in the past, make that work economically efficiently. But there will also be a lot more regulation if Biden gets elected, which is looking probable. So there'll be regulation in not only health, but in energy. And there will be immediate rules on masking, distancing, testing, and there'll be a lot more government surveillance going on. So these will be some of the changes we can expect if Biden gets elected. There will be fewer market forces as a Republican would prefer. Mike Feeney, you said under MMT, what's MMT? Running up debt is not a concern until it becomes inflation. That's right. So you're right, Mike. When the debt is not a concern if you don't have to pay interest. And with interest rates where they are, there's no cost to putting out the debt. The real problem becomes if anything becomes inflationary down the track. And as we've written many times about the risk of inflation in the U.S. is reduced by IT advancement and efficiencies and productivity efficiencies, but also by collective learning and things like that. So there's been very low risk of inflation in the last, say, 20 years because of productivity improvements and because of IT making everything just runs more efficiently. Alban has a question. Where were interest rates in the 30s? Well, that's a good question. I don't know the answer to that. Steve, do you know where interest rates were in the 1930s when Roosevelt borrowed all that money?
Well, I think economists today, for instance, Ben Bernanke, his PhD thesis was on the causes of the Great Depression, and Hoover's Fed chair actually raised interest rates to try and curb the inflationary pressures that happened in the 1920s in the U.S. and all around the world, and that is what arguably knocked the U.S. into a depression as opposed to just a shorter term recession. But I'm not sure what the exact rate was. I think it went from, well, I don't quote me, but I do know that interest rates increased in the late 20s, early 30s. Before Roosevelt started spending.
My memory's failing me, Steve. I don't remember what interest rates were in the 30s, but I'll try. Maybe if I did some associate. Actually, no, I wasn't alive in the 30s, Al. Now, Doug has an interesting question on the elephant in the room. What Doug's question is very valid, and that is that isn't COVID making the rich richer and the poor poorer, if I can summarize what you're saying? And the answer is yes. And one of the reasons Biden's more likely the Democrats are getting some attention is that the poor need to be supported now, and the rich getting so much richer in this COVID velocity of creative destruction, or this change, or the nimble people getting rich off of the tragedy is a very important issue. And so for the Democrats to come in and tax the rich and help the poor may be a natural shift in sentiment in the United States. And we'll see what will happen there. But you're right, that is the elephant in the room.
And just to go back to the interest rate, in 1930, the nominal rate was 5.85%. But in 31 and 32, there were continued inflationary pressures. So the real rate was more like 13 or 14%.
That's pretty high. And we're scraping along the bottom now as a result of Greenspan's policy of price containment and asset appreciation over 25 years. Let me get back to this slide here. We're now looking at a trade deficit in the United States, not a 50 billion a month, but more like 70 billion a month. And you'd think that with President Trump's policy of trying to get better trade deals around the world, that the trade deficit would have been lower, and the U.S. would have been more on an equal trade footing with other countries, and it hasn't turned out that way. And the reason it hasn't turned out that way is because his economic policy has resulted in a much stronger economy than anywhere else in the world. So if the European economy, for example, is weak and the US economy remains relatively strong, then the US is going to continue to import things from Europe and not be able to export. So as a result of that, the trade balance has increased because of US economic strength. And I want to help people to understand why the trade balance is not doing what one would have considered it to do. One would have expected it to do under Trump's fair trade policies. But the trade deficit is worse. If Biden wins, of course, one of the big Trump things that he really got a pulse on the world on was holding China accountable. And there's news today that isn't in the report that I want to point to. And in the morning meeting this morning, I said to the staff, I said, who's the boss? And the answer is not me, it's Xi Jinping, because he told Ant Financial, you're not going public. And Jack Ma went to a roadshow to raise money for his Ant Financial business, which was supposed to float today or tomorrow for $35 billion. He made a comment. He said that if in China, if you borrow 100,000 yuan from a bank, you get nervous. You're going to be able to pay it back. If you borrow $1 million, you're nervous and the bank's nervous. But if you borrow $1 billion, then you're not nervous. The bank is nervous. And this comment did not go well with the party in Beijing. He was called to Beijing, and the IPO has been put on ice. So Trump does have a sense that there is in China enforced harmony, whereas the United States has a lot of public speaking or outcries or a lot of loudmouths. So the question becomes, will Biden then go soft on China? And I actually believe that it's been better for the United States and for Qualcomm, in particular our investment Qualcomm, that Trump did go hard on China and held Huawei accountable for their alleged taking of US IP. But Biden would go softer on China, would have more friendly foreign policies. I think a bigger question is, will Biden last by 8 years? And I think the answer is no, and that depending on whether, there's always a risk he could die in office. Would Kamala Harris become president? And we're just putting that out there as something for people to think about. China will now, if Biden's elected, which is looking probable, China will engage with corruptible zones, with their Belt and Roads initiatives, where they go to Africa and Burma and the stands and expand by investing in infrastructure, and then invest to own is the idea. If people are familiar with the concept of invest to own, it's where you invest to build stuff, but you leverage the country so high that they'll end up having to give you the assets when they can't afford to pay the debt. So where's the world going in 20 years? Will we have enforced harmony spreading throughout many of these corruptible zones where the U.S. won't go, or will we have public displays as we have in the United States? And the world seems to be dividing along those lines more so than I've ever seen. Getting into the earnings results now and off some of the philosophical issues, banks in Europe boomed this month, up 15%, big result out of European banks, whereas Visa, MasterCard got crushed, and they're not an opportunity to buy on this weakness. The asset impairment charges from the major US banks were $30 billion in the second quarter, and there's almost no asset impairment charges in the third quarter. So we've seen a big turnaround. For example, JP Morgan, which had 10 billion in asset impairment charges, only had 600 million. Now, we were concerned that there would be more asset impairment charges, and it didn't eventuate. So the banks are looking better than we thought, but the stock prices have not been performing as well as we thought. Investment banks with trading departments are doing very well with their selling of a lot of product to the central bank, to the Fed, and they've had giant earnings results at Morgan Stanley and Goldman Sachs. Now, Steve, you want to talk about Goldman Sachs some?
I'll talk about Goldman.
Yeah.
Okay, Chris?
Yes, that's a good summary, Joe. The Main Street lending arms of financials were less bad than feared this quarter. A lot of the provisions in the previous couple of quarters for anticipated loan losses have not been realised, and part of that is there's a delay in the anticipated losses because of the compassionate extensions and things like that. But meanwhile, the Wall Street divisions are having a fantastic couple of quarters, and one of the main drivers there is volatility, which positively impacts revenue across a number of divisions. And at Goldman Sachs, it was especially the case with trading revenue. That's equities and fixed income, currencies and commodities. Trading revenue was up nearly 30%. And fees that they derive from underwriting bond and stock offerings as companies tap markets for capital. That was up 60%, and they remain one of the leaders on the merger and acquisition league tables again this year. This quarter served to dispel those concerns that the strength in the first quarter, capturing the pandemic period, was a one-off. They've had another exceptional quarter, yet the stock continues to trade sideways. It's trading at 86% of book value, which Goldman has managed to grow, and 8.1 times 2021 forecast earnings.
So if the interest rates went up 50 basis points, this stock would go to 300. So we're waiting on this. It's having great results. They've got a lot of money. As a result of making a lot of money, they are paying higher compensation, and they are also raising money cheaper for their own investments through this Marcus platform, which is where they take deposits online from retail depositors, which gives them a cheap source of capital to invest across the market. So I think that cheap source of capital coming in fast through their Marcus product should allow them to do very, very well if interest rates go up 50 basis points and we start coming out of this this thing. Biden would not be as good for banks as Trump would be, of course. In consumer products, we've seen some selling down, except for Coty. Now, Coty has been a horror story for 5 years. They're a New York-based cosmetics company that's highly leveraged and not well managed. And they did bounce this quarter, but other than them, we've seen Colgate, Church & Dwight, and Clorox, whose sales are largely correlated with GDP, and where they're constantly on these cost-cutting missions. And now suddenly Clorox, for example, selling all the right stuff, like bleach and charcoal and things that just clean. They're going to start blowing money, as they said, on at 23 times earnings with GDP growth. It's just not an attractive story. They're overbought in this cycle, in my opinion. 25 times is too expensive. In food, it's a very similar story with the exception of Kraft Heinz. So whereas Coty had a bounce, Kraft Heinz had a bounce. And if anybody is familiar with, Australians probably are less familiar with Cheese Whiz than Steve and I are, but they have what they call their natural cheese division, and their what was you'd assume is a non-natural cheese division. But they did sell their natural cheese division. The stock is up significantly as they reduce debt that they got from this leveraged merger. And so it was a nice relief for them to sell their natural cheese business and reduce some debt. But they're going to keep the non-natural cheese, the Cheese Whiz, and the Kraft slices, which we see in the local supermarkets, although they're not quite as yellow. We remember Cheese Whiz. Good on you, Tim. And Coca-Cola, of course, half their business is from the, through direct to consumer, and half is through events. And who's going to talk about Coca-Cola today?
Yes, I'll talk about Coca-Cola. We invested in July. The stock had lost about 20% of its value in the early stages of the pandemic. And what we've seen is a story of, like a lot of companies, a story of sequential improvement. The quarterly...
Well, it's up from when we bought it though, right, Chris? So it's not down 20%
right.
Since we bought it, yeah.
Yes, that's correct. It's up about 10% since our investment. But it's very much a story of sequential improvement and a relatively low risk post-pandemic reopening sort of investment thesis, in contrast to, say, an airline or a cruise line who rely on that very high capacity utilization we talked about. From a decline of sales by volume, which was down by 25% in April, the third quarter had seen dramatic improvement, and it was only down 4% versus the prior year. The stay-at-home channel demand remains quite elevated, and meanwhile, as the economies reopen, especially in North America, the away-from-home channels are showing improvement, with movie theaters and sporting events and things closed. We've also seen an adjustment in consumer behaviour. So the quick service restaurant channel, which makes up a good chunk of that away from home, we've seen consumers, in the absence of being able to dine in, have an average, a higher average ticket size, focusing on family and value offerings, and instead opting for drive-through and delivery alternatives to continue to consume. So overall, the investment thesis is playing out very much as we had anticipated. And I think the pandemic also obscures what Coke has been doing for the last 3 or 4 years, which has been removing from the balance sheet the lower margin, capital intensive bottling operations. So the Coca-Cola system very much partners now with off-balance sheet bottling operations, and in a continuation of that trend, I suppose. We've seen news this month or last month that Coca-Cola Amatil will be acquired for, I think, all cash by Coca-Cola European Partners, which is a bottling-focused business.
Now, Kelly, have I messed up the view on my screen here? Does everyone still see a full screen of the PowerPoint?
Yes.
Yes.
Oh, they do? Okay, so it's just my screen that I've accidentally clicked on the Q&A wrong. Now, Coca-Cola Amatil, in an Australian context, is a very unique business. And the ASX already has a very narrow offering of mostly banks and resources. So I presume that there are a lot of Australians who are very concerned that this asset class is being taken away from them at what I would think would be a predatory price in a weak market. It must be very disappointing for Australians to see Coca-Cola Amatil getting taken over. So I would suggest that you have a look at taking the proceeds from what you get from Coca-Cola European Partners and perhaps buying their stock in Europe to maintain some balance in your portfolios. Entertainment. Wow, this is really the hot spot. I'm going to try and push through to the conclusion here because I've written quite a bit here, but there's, you know, the velocity of creative destruction in the Wintel or the Windows Intel 2-year upgrade cycle or the iPhone upgrade cycle is really a ram down your throat strategy where Windows is saying, take the new product. Whereas when we look at gaming, it's not a ram down cycle, it's a pull through cycle. So it's based on consumer demand as the chips continue to advance and provide much, much better product for people. So as a result of the pandemic, and this is addictive gaming, there's the big surge here is going to lead people into, and I'm not, I have my my values and my ethical investing hat on here sometimes as well, and don't like gambling, but this is an addictive stuff. Electronic Arts, Activision, Tencent, Take-Two, there are dozens of smaller companies are being acquired. Microsoft just bought the maker of Doom for $7.5 billion, and Moore's Law is creating new, you got a 15% increase in people who are playing games, numbers. The hours per week are up from 14 to 12. So gaming is just really taking over. This interactive socializing online is preferable over watching a movie in a passive way. And it's more of an active participation, and it is quite addictive. So what we're seeing in Moore's Law, now Andrew, just explain what Moore's Law is for everybody.
Yeah, sure. So Moore's Law is a concept in the semiconductor world that basically states the number of transistors on a chip doubles roughly every 2 years. And the semiconductor industry is driven by this persistent approach to shrink. So the more transistors you get on your chip, the more powerful, efficient, and cost-effective they are. But we're running.
And the better the graphics are on a new game. And we have this FIFA, sorry to cut you off there, Andrew, but we have this this new game out from Electronic Arts, this FIFA 21, had 3.5 million people log in on the first day. We've got Facebook, Amazon developing cloud solutions for streamers, as well as the stuff on your mobile phone. I don't know how many of you are playing, you know, anonymously, you know, under cover of the of your computer, but who's playing Candy Crush Sugar or Pokemon Go? I know I haven't played Candy Crush, but I've played Pokemon, and these things are very popular. We've got new releases of the Xbox coming out from Microsoft and the PlayStation console from Sony coming out before Christmas. We're going to have another big upgrade cycle, and I think this stuff in online gaming is just unstoppable. So there were about 10 billion in acquisitions so far this year. There was about 8 billion all last year, and there's going to be a lot more. So Electronic Arts did sell off with the sector some. They're going to report tomorrow. We're looking forward to that report. The CEO, who by the way is from Geelong, if you know where that is, down near on the way to Torquay. Andrew's an Australian, and he's saying that this bump up in demand as a result of COVID is just bringing forward what was going to happen otherwise, and he has no concerns about a fall off when the economy reopens and people go back to watching AFL games. They'll still have the same number of hours on their games. So this new FIFA 21, that's the European soccer, 3.6 million on the first day. That's just wow. They've done really well with that. They've got 3.7 billion in cash, and I really want to see them announce some big acquisitions. They've got a great throughput channel where they sell product through Sony, Microsoft, Apple, and their Alphabet channels. They got a great channel, and they need to start announcing some acquisitions. Is what I'd be expecting from Electronic Arts. Let me, I don't see any questions coming through there, but I am very happy with that investment. CBS Viacom, not so much. Who's going to talk about CBS Viacom?
Sure. I'll touch on that. They'll report on Friday, but since March, following the completed merger with CBS, which was finalized last December, the company struggled a bit, but it seems that they have found their footing. Since mid-March, the shares are up 167%. Now we still have a ways to go to our break-even level, but they're trading at 6.5 times earnings. They continue to grow their earnings per share by about 10% annually. It looks like good value. They've made steady progress on their streaming platforms. They have about 30 million subscribers across all of their streaming offerings. And as we have said, for years, is that content is king in this space. And Viacom and CBS have a great library of content, particularly with the Paramount Studios division and 80 or 90 years of movies that they can distribute through these new platforms. But we expect 79 cents a share earnings, and we'll see how they go on Friday pre-market. Joe?
Sorry, I pushed mute there. I'm back. On healthcare, Big Pharma has what's called the patent cliff risk. That means that they've got a drug that's coming off a patent and they're going to lose sales. Of course, those sales end up in the generic companies. And they've been very good defensive investments through COVID with low PEs and high yields. But they're starting to fall on concerns that Biden would regulate them. Now, in biotech, they don't have patent cliff risk. What they have instead is FDA approval risk, as we saw with Vertex and their drug not making it through last month. And so but we do want to take some exposure to this sector with the recent weakness, and so we're buying Amgen. And Amgen is something that has very little patent cliff risk because their 15 or so drugs are not currently pending patent exposure. Only one of them is coming due maybe in 3 to 5 years. But they have a couple of drugs in the pipeline, so they really fit in somewhere in between a biotech and a big pharma, being the biggest biotech, but not quite a major pharma. They also have a very good, strong track record of delivering new drugs to the market and commercializing them. So they started out with Epigen and Neupogen back in the 80s, which stimulated red and white blood cells, and now they have 15 drugs. They made a big acquisition last year, getting them into the osteo and arthritis and sclerosis business. So we're recommending Amgen. So who's going to talk about Amgen? Is that you, Steve, or Chris?
I'll touch on Amgen briefly. So Amgen is replacing Intel in the 9-stock relative value portfolio. It's sort of the original biotech company, if you like, founded 40 years ago. 126 billion market cap with about 25 billion in annual sales. And really the rationale for investing here is the compelling valuation, about 13 times earnings, and an attractive dividend, close to 3%. And we think, we've deduced that the stock has languished due to investors being unduly focused on the companies with the best prospects of developing COVID-19 treatments. So it looks like an overlooked situation, and a pretty classic relative value model portfolio candidate.
Thanks, Chris. Their Prolia, or their osteoarthritis drug, is the only patent risk, and they do have a couple of good drugs in the pipeline for migraines and for lung cancer. Medtronic is not done as poorly as Boston Scientific and Edwards, who are more exposed to the elective surgery market, and Medtronic has been fine compared to them. But there should be some pent-up demand for these elective surgeries, and there should be some reopenings around the world. We're expecting good results from them when they report much later in the month. Mylan reports on the 6th, so we do have 4 companies reporting this week. In software, I want to touch on this important concept where there's been some testimony in Capitol Hill by the CEOs of major firms. Back in 1996, there was a law passed which effectively said that internet companies aren't liable for third-party content. Now, of course, during the attempt to kick Trump out of office and the Russian interference and the fake accounts and the fake news and all of that noise, there's been a lot of concerns, particularly by Democrats, that these channels are being used to distribute false information. And a law can be changed. So a Section 30 internet law indemnifying third parties is going to change. It's not like they're going to go to Capitol Hill and say, we don't want to be exposed to this. Now, what will happen here is there'll be something called regulatory recapture. And I go back to when the head of GE Australia was presenting to Amgen back in 2007. And it was so clear from Steve at the time, the guy who was doing the presentation, that GE was driving the regulatory framework to accommodate new concerns about global warming. And by driving the framework for the new policy, they could help drive policy that suited them and that they could comply with, that would be hard for startups to comply with or understand. If you write the legislation, you're going to be able to deal with it, and it's going to be best suited for you. So get involved in the change is the answer. Now, what we haven't seen from Apple, Microsoft, Alphabet, and Facebook yet is them endorsing a change to Section 30. And a change to Section 30 would benefit them if they draft the legislation. It would reduce it would make it very hard for startup companies to comply with rules. So this regulatory capture issue is likely to come through and solidify the positions of the big technology companies. And so it's an important concept to sort of get a handle on here. And Alphabet did report earnings. Who's covering Alphabet?
That would be me. Yeah, very good result, 15% revenue growth. They had a bounce back in their search ad revenue, which bumped up by about 6% versus a 10% decline last quarter. Google Cloud had the best results across all divisions. Sales were up 45%, which was well ahead of expectations. Total revenue for the quarter was $46.2 billion versus the estimate of $42.9 billion. So we had about an 8% beat there, and a huge beat in earnings per share on better than anticipated cost management, $16.4 versus the $11.42 estimate. YouTube sales were up 32%, again, which was a big bounce from the single-digit growth they had in the previous quarter. And overall, EBITDA beat consensus estimates by about 21%. So it was a great result. In the midst of all that, the DOJ has filed an antitrust suit against the company, but it's very narrow. So analysts breathed a sigh of relief. It centers around the arrangement Google has with handset manufacturers in the traffic acquisition costs. So they pay Apple about $8 billion a year to funnel all search traffic through Google. So that is what's been highlighted by the DOJ in their antitrust suit. And so it could have been much broader.
We're very happy with that. Intel, Bob Swan has really screwed it up on this server chip market. There's a lot of companies merging and circling and advancing. AMD is buying Xilinx. And we have other mergers going on with ARM Holdings being acquired. So we were very disappointed in those results. We sold immediately. It kept falling, but NVIDIA and AMD seem to be getting more critical mass and standing up to Intel, and Bob Swan is not delivering. Qualcomm reports on Thursday. Excuse me. So Trump has been protecting the U.S. from China and Huawei, and Trump would be a better solution for Qualcomm. Excuse me. GE, I'll skip over that because we're just about done here, but I'll say that their aviation business is selling engines to Boeing, who destroyed Bombardier with that lawsuit, and they're working with Airbus. But GE seems to be starting to see some light with a positive cash flow in the manufacturing sector. In terms of economics of the Melbourne Cup, you know, this is sort of tongue-in-cheek and a bit of joking around here, but ladies looking for husbands are going to have to find alternative sales channels. I can hear you all laughing there. I think that the demand for women will remain relatively strong, and that that online dating is likely to benefit. Marriages will fall next fall. LOL means laughing out loud. The relative value model, Goldman Sachs, Coca-Cola, Viacom, CBS, Viacom, CBS, Electronic Arts, Mylan, which we're hoping turns the corner, a new addition, Amgen, Medtronic, Alphabet, Qualcomm, and still a 10% cash position with two supplementals in Baidu and Alibaba, where the deal was canceled overnight, and then of course the the excellent long-term results with a dip this year. Take us right up to the top. So I'm going to turn it over to question and answer now. Steve, Chris, any final comments?
No, I think that covered it. We'll be getting reports out on Qualcomm and Viacom as the earnings results come in.
Joe, I believe there may be a question.
Election prediction.
Trump had reclaimed favoritism with TAB. I don't understand that.
So the betting odds have swung in Trump's favor in the last hour or two, but it's still, we've got a lot of results to come in, but right now the bookies are projecting Trump winning this thing.
It's a toss-up. I thought Biden was looking like the winner, but you've got to wait for the votes to be counted, and then we'll reconsider our portfolio after that. I would say that the U.S. Is a much better bet than Victoria, based on the productivity frontier. So from a purely economic point of view, and not a saving lives point of view, the U.S. economy is going to be stronger than anywhere else in the world, regardless of who's elected. Well, thank you, everybody, and we'll be happy to take your phone calls at any time. So call me or your advisors later on, and we'll log off for now. Thank you.
Thank you, Joe. A replay of today's webcast will be made available shortly after the conclusion of this event and will be emailed to you. Listeners with additional questions can contact myself or the team by phone or email as per the contact information available on our website. And that does conclude today's webcast. Thank you all for joining us, and we appreciate your time. Stay safe, everybody, and we look forward to speaking with you all again. You may now disconnect.
Yeah, maybe we'll have a Christmas party in the office. Yeah. Okay.